Good morning. I'd like to call to order this meeting of the Empire State Bond Financing Committee. This morning I'm requesting that the committee approve a resolution authorizing the sale and delivery of the New York State Urban Development Corporation Personal Income Tax Revenue Bonds, Series 2014 A and B. The bonds will be issued pursuant to the New York State Personal Income Tax Revenue Bond Financing Program and will be secured by a pledge of payments made from amounts legally required to be deposited into the Revenue Bond Tax Fund. The Public Authorities Control Board approved the issuance of these bonds on November 17, 2014. Proceeds from the sale of the bonds will be used to finance certain state facilities, certain highway and bridge projects, economic development projects, and certain other state-supported programs. In addition, UDC will issue bonds to refund bonds previously issued by the corporation, New York State Housing Finance Agency, New York State Thruway Authority, in accordance with the state finance laws. The bonds will also finance related cost of issues. In accordance with the attached resolution, the directors are requested to approve the forms of the supplemental resolution, the preliminary official statement, the official statement, notices of sale, supplemental schedule to the financing agreements, and related documents in connection with the proposed sale and delivery of the bonds issued on a public competitive basis. The directors are also requested to authorize certain officers and employees of the corporation to take all actions deemed necessary to accomplish the final sale and delivery of the bonds. Please note that by approving the Financing Committee resolution, you will be establishing $1.55 billion as the aggregate maximum principal amount of the bonds that may be issued, establishing a maximum true interest cost of 7.5% for the tax-exempt bonds and 10% for the taxable bonds, and delegating to certain officers and employees the power to determine the terms of the bonds within the parameters set forth therein, including but not limited to the final aggregate principal amount of the bonds, the principal amount of each series of the bonds, the principal amount of the bonds maturing in each year, and the final maturity dates, which shall be no longer than 30 years after the date of issuance, and the interest rates to be borne by the bonds, and make such changes to the related documents as he or she deems necessary and appropriate. Are there any questions?
So there are no underwriters in this deal?
No.
Right. So the only other question I have is, I noticed that the maximum interest rate was like way above market.
We do that just in case. Yeah, I saw your head come up.
When you said 10%.
Yeah. No, that is not the interest rate we're expecting to get on the bonds. We do that so, if anything should happen within the markets, we're able to accommodate it. What I will do, as I've done in the past sales, I will, circulate an email to everyone, stating the exact interest rates that we will get.
So the idea is just give yourself a huge amount of room.
That's exactly. We want to have a range in there in case something might happen.
Well, this is a range, all right.
Yeah. We don't anticipate to get that at all. We anticipate to do much better than that.
Yeah. All right, good. All I have. Looks good.
Anthony, good morning. Good morning. How are you today? Thank you for joining us.
If it was a good morning.
My pleasure. Wanted to give you, again, appreciate as always your participation and assistance, and wanted to give you a chance to ask Rob. Liz Fine has joined us. Liz, Jonathan, if you've got any questions regarding this issuance and the matter before us.
No, the presentation was helpful. Thank you.
Very good. Thank you. Good morning, Liz.
Good morning. Sorry, I was stuck in a meeting.
That's all right. We're happy to have you. Mr. Byer, welcome, by the way, to these proceedings. I know we took action in our last meeting to have you join, and glad to have you do. And you are intimately familiar with this, I suspect. Do you have any questions or comments?
No. I think everything we need to know is in the documents, but this is a fairly typical transaction in the sense that we've been issuing these PIT bonds essentially on an annual basis every December and funding our economic development projects with those funds. This one, we don't always do a refunding, but we are doing a refunding of prior PIT bonds issued not only by ESD but also by HFA and Thruway. Thank you.
Great. Well, then I just have a couple of quick questions, which, you as a fellow director can answer. Certainly Rob can too, I'm sure. And I apologize, Rob, this was probably in your overview, but what's the breakdown between the new issuance and the refunding?
Okay.
The total is $1.3 billion, right?
That's the total amount. That's
the
correct.
taxable, non-taxable.
That's correct. The refunding part is going to break it down, ESD, there's like 164 million of the bonds. HFA, we have 116 million of their bonds. And the Thruway is 278 million of their bonds. And we're looking to realize a net present value savings of those refundings of 62 million. The refunding in total is about $500 million.
This sounded like, 500 to 600 million.
Mm-hmm.
But the NPV savings, because of reissuing at a lower interest rate, should be something like $6 million.
Yep, that's what we're looking to realize.
And the savings accrues to those agencies, respectively?
It goes back to the state.
It goes back to the state.
Yeah, because it lowers their debt service obligations.
Right.
Is that savings a net number, net of all expenses, fees, and everything else, or is that just the difference in the debt?
That's a net number.
Net number.
Mhm.
Okay.
And also, just to clarify, Derek said there's no underwriter in a specific sense, right? But we do have firms who are doing the sale for us, right?
Yes, we have firms that are lined up to bid
So
on this.
if we don't call them underwriters because they're not taking on the liability, what do we call them?
Okay, they could also be underwriters, but when I answered Derek's question here, I was more thinking of a negotiated in which we choose the underwriter.
Now, this is sort of the sales force.
Yes, exactly.
But they bid for the bonds,
They
and
bid.
then they win whatever they win,
Uh-huh.
and then they can either keep them in inventory or resell them or whatever. But that's up to them.
It's
That's-
their bonds.
Yes, okay.
What's going to happen is, at the set times, we'll be looking at our terminals. We'll get onto the system. Right now, we have about 8 or 9 banks that are interested in bidding. At noon, we're going to see all the bids come in, and the lowest bid is going to be awarded the bonds for that.
At
sale.
noon.
But they
Sorry?
get no underwriting fee. Their profit is whatever the spread is
That's
they get.
absolutely
Right? Is that how that-
absolutely.
yeah, okay.
Mhm.
So they don't get an underwriting fee.
Right.
There is a fee built in there, but it's tighter than what is normally done in a negotiated.
And also, just to distinguish negotiated from competitive, a lot of times the firms that we select in negotiated transactions provide a lot of advice and not legal counsel, but counsel as to how we should structure the transaction, which bonds should be refunded, not be refunded. In this case, because it's competitive, none of those underwriters have performed that sort of advisory role, but we do have use and have used Division of Budget's financial advisor.
Mm-hmm.
And our outside bond counsel. Who's here.
And our outside bond counsel. So we're sort of covered on the sort of expert advice. We're not getting it from the underwriters, but we are getting it from a financial advisor.
Right. Now, I'm glad Derek asked the question. We've just spent a little time on it, and it's something I've talked to Margaret about, and I think you're aware from my comments at the committee meeting, which is, my concern that when we issue bonds this way competitively, we don't provide sufficient opportunity for MWBE firms to participate and for them to make the fees and and I think we know that historically, and there have been several. DASNY's done a recent report. I got a copy of last week. And I just want to raise again, Mark, on the record, my concern that we're not taking sufficient steps to create opportunities for MWBE firms to benefit and participate when we do debt issuances on a competitive basis like we're doing today. Now, since I raised this point at the last meeting, I've again had conversations with chamber staff, with Alfonso David, with Margaret, obviously, and with, as you can probably tell, my friend Paul Williams, who runs DASNY, because he and I share this concern. And let's call it a debate between issuing agencies like DASNY and ESD, which remain the two main issuing agencies for the state, and the Division of Budget. The Division of Budget has a fiduciary responsibility, understandable. We have a policy responsibility, which is to advance the governor's goal that's now 30% MW procurement. And debt issuance is when you have firms coming in to help you issue debt, that's a procurement. And so, again, I just want to continue to state my concern that I think, we need to do a better job at making sure we advance the governor's broad goal of MW participation when we issue debt on behalf of the state. And based on my conversations with Margaret and others, as I've mentioned during the past couple of weeks, I know we're looking at this issue and people are very focused on it. Again, this is a level of detail, Martin, perhaps not so important, but one idea that was raised, although I think in fairness it was raised probably too late for this issuance, that's why I asked my question earlier, conceivably one could split an issuance like this and, for example, do the refunding on a negotiated basis and the new issuance on a competitive basis. It's $1.3 billion, $500 million of which, theoretically, you could, right? Again, that might be an interesting idea. I admit, as I advanced it too late in the process, this stuff had to get done. You have a timing, deadlines to meet. But it's those sort of solutions or, compromises, if you will, that I think we need to pursue aggressively. And so, again, I just wanted to raise this concern of mine on the record, as I do or try to do, for all aspects of procurement for this agency. And we're always mindful of the governor's goal and of the spirit behind that goal, which is, again, providing opportunities to firms that otherwise might not have access to this. So I just wanted to raise that and share those concerns. Having said that, and I have one other question. I'm sorry, technical thing, but when you look at the projects that are taxable, some of these, I'll make one up, New York Genome Center, and we've made a $100 million plus commitment.
Yeah.
That's viewed as taxable. Who decides which? I know this is IRS law, but who decides which are taxable beneficiaries of the issuance, and which are not tax exempt?
That's our dear friends from Harris Beach, bond counsel.
Aha.
We go through a long diligence process with the tax counsel there, and details of the beneficiaries and what the funds are being used for are described and gone in great lengths as to what's going to happen with the funds. Then our bond counsel will determine whether or not it can be taxable or tax exempt financed.
And two points to add to that. One, Brendan works very closely with specialized tax counsel from Harris Beach. Not that Duran is not broadly familiar with these concepts, but ultimately it's the specific tax counsel at the firm that generally writes the tax opinion, and the firm has a tremendous personal interest in making sure that what's taxable and what's tax exempt is appropriately categorized.
Is there, in layman's terms, Duran, Brendan, Jonathan, as I look at these projects, what is it, in layman's terms, that turns what otherwise might appear to be a tax-exempt project into a taxable project? That may be a hard question, I apologize.
Tax code, tax-exempt finance is intended to benefit governments and secondarily not-for-profits. So most of the time, what the analysis goes to is determination whether there's something called private endowment, meaning is the beneficiary of the borrowing an eligible party to receive tax-exempt finance. And for-profit entities or entities that clearly aren't governmental entities or aren't clearly 501c3s. You could be a not-for-profit and not be a 501c3.
Right.
So if you're not in those two basic categories, there are exceptions, but if you don't meet the exceptions, the federal government is hostile to tax-exempt finance. Every dollar of tax-exempt finance that's issued is money that the federal government never sees from a taxing perspective. So the code is very, I won't say it's clear, but it's very detailed about what qualifies and what does not qualify. And as a result, we work very closely to make sure that that each and every project is analyzed, meets the tax code. We work with UDC. The biggest problems are the close questions, obviously, and there's guidelines, and at some point you reach a level where you're just not comfortable that private enormement or other considerations of that nature you're not in a safe harbor, you're in a place where you just can't take comfort, and so you're forced to make a conclusion that these are not eligible projects, and therefore they can be financed, but only on a taxable basis.
And that line has become somewhat more complex and blurred as public-private partnerships
Right.
become more popular and more sort of endemic.
More
Some of
common.
it's more common. If the state has the possibility of sort of sharing a facility or sharing the results of the research or a product that's made in that facility, and the state has the ability to sort of take a percentage of it, either in patents or a percentage of the profit or whatever, that now the fact that the state is benefiting from that in effect is treated as private use. It's no longer sort of a governmental project, because the IRS does not want the state to sort of say, we're going to borrow tax-exempt money, invest it, make money, off the tax-exempt money. So there are a lot of levels to determining.
But it would be safe to assume then, if housing, Buffalo Bills, Brooklyn Regional Innovation Center, I mean, some of these I think I can imagine because I know the parties, economic transformation program and so on, you determine that all of those I know have private parties involved at some level. So maybe it's a matter of degree, but I think the Buffalo Bills, we all can imagine, is a private entity as an NFL football team. So, you can't make the case that renovating the stadium, which is what the proceeds are, that's really, I mean, a lot of Buffalo Bills football fans would say it's public good, but in fact it inures, some portion of that inures to the private owners of the team, right?
Mm-hmm.
So
Do they own the stadium? Does the team own the
the
stadium?
county owns the stadium.
That's the distinction.
Yeah, that's what I was
If the
thinking.
county owns the stadium, it's a governmentally owned facility.
Right.
And to that extent, you can make improvements to the stadium. You might not be able to do the dressing rooms because that's probably not infrastructure. It's
Right.
directly related to the team itself. So, and these are the kinds of analysis that
For
our
each.
tax people would
Right.
do, is what exactly is being done at the stadium, and is it more of an infrastructure basis that you can say has an economic development, spin to it, or is it more of a true private enormement, so you can't do it? If we were doing the sidewalks that lead up to the stadium, I think most people would
Right.
say that's not a
Well,
problem.
your colleagues must have determined in that instance, for example, that while the county owns the stadium, some of the benefit of this issuance would have inured to the private owners of the team, right? Fans are happier, they buy more tickets, nicer stadium, enough to trigger this sort of above the threshold that's taxable, right? Economic Transformation Program is a program, as some of you know, that was created in response to the governor's closing of upstate prisons and creating a block of funds so we could help rebuild the economies of communities, frankly, where the prisons had been the major employer, and you used to lose all those jobs when you close a prison. So, and we work very closely with local governments, but I could see the example here is that, and Brendan knows, when we actually make those grants, we're actually, in some cases, making them to companies as incentives to locate in an affected community, and build a new factory or a hotel or a this or a that. And so while there's a social and community benefit from the investment, there's a private party that is, the beneficiary of the investment, right? So you could see as you go through them, New York Genome Center probably is partly this, tricky situation where it's both public and private. There are 12 healthcare facilities in that project. It's a complicated consortium. I think they're all nonprofits, but to the extent that there's one for-profit hospital in there, right, or somebody, there must be, or someone deriving benefit from the results of the genomic research.
I know there's, that one in particular, state has a royalty agreement, so naturally if the state
There you go.
is successful, the state's going to get
Well,
It could also be working capital. Depends on what the grant is for.
I apologize for taking up time to my fellow directors, but when looking at the list that Jonathan sort of laid out for me, it's just interesting to see what what has to be determined as taxable and what doesn't. And I can appreciate, not just by the weight and thickness of this document, but all the work that goes into preparing this. Well, I have no further questions. back to you, Mr. Godley.
You need a motion?
Thank you. Yeah, may I have a motion on the item?
So moved.
Second?
Second. All in favor?
Aye.
The item is
Aye.
passed.
Thank you, Anthony.
Now, my motion
Thank
to
you.
adjourn the meeting.
So move.
Second.
Second.
The meeting is adjourned.
Meeting is adjourned. Thank you very much. You got 32
care, everyone.
minutes.